All right, let's go over part two. Now that you understand the basics here, I want to go a little bit further into how these basics apply. I want to look at safety when it comes to chasing the rule of 72 and chasing interest rates. Let's talk about where there's risk, where there's safety, and I want to talk about volatility over time. And I also want to talk about tax considerations. That's another huge point that gets into it, and there is some saying somewhere that it's not how much you make, it's what you get to keep. All right, so the only question is, now I've got portions here that are from other slides, so I just throw them in. I threw a lot of slides from different shows here, so some of them might come in a little, start a little non sequitur, but I think they all get to a point. When you're doing retirement planning, you're looking at where you're trying to get to on your investing or your saving or whatever. The question, if you do what retirement planners do, is you always work backwards. You start with how much is a person going to need, and then I'll tell you what you need to do and how long you have, and how much risk you should or should not take. And then you got to add that up as if you were already retired. So this is just a key thing to always looking at how, what is the goal? What's the goal of trying to invest? So ultimately, you want to fill this all in, know what it costs to live the lifestyle that you're interested in living, and then that gives you a target that you can operate from on doing your actual planning in a strategic concept or a strategic environment. Now, um, when you then know what you need to have coming in, you're now going to look at what sources will that income come from. This is an important thing. I just want to mention this. A lot of people have the idea that you have to have a certain like bulk of money. You know, I have to have 1 million or I have to have 2 million to retire. But what is that determined on? That's determined on what you're going to need month to month or year to year to live on. So assets convert to income once you stop compiling them or accumulating them. You go from an accumulation stage to a distribution stage. So you want to know what the distribution stage is going to look like. Earlier here, a slide ago, we looked at the expenses. Here you look at what will be your sources of the income. So how much Social Security? That's an inflation adjusted income guaranteed for life. Do you have any pension coming in? That's a fixed income guaranteed for life. Well, you have earnings from your work. That could be fixed or variable income. It could go up and down. If it's just earnings that you've saved, then it may not be permanent. There's no guarantee that you won't use it all up and run out. And it would cease with maybe a major illness, or it could cease with old age. And then you've got what's called asset income. That can be fixed or variable. Oh, yeah, okay. There's a few different. I left something else out here too. So assets can generate income because you have a money manager that's buying certain bonds and getting into certain REITs and stuff. So that would be one way of looking at it as a money manager. The other way, which we do need to totally acknowledge, is that you may buy real estate and you might build a real estate portfolio, and that could generate income for you. Or you might buy oil wells. I mean, there's a lot of ways you could invest to generate income, but those that would be assets generating income as opposed to spending down your earnings from work. So that's where I was going with that slide. Let me find my cursor here. All right, we'll just go with that. All right, so the retirement income management process, and that is something we focus more on later on with people, but I do want to bring it up because again, it's a point that I come from even when I'm looking at what to invest in. I'm still looking at uh, where's it got to get me. So the retirement management income process. Step two of that process is to identify specific risks. Step one is you look at what you got to make, what your plans are for income sources, and then you look at what could endanger those sources. So when it comes to making your plans to get to and sustain the next chapter of your life, today especially, it is important, and this is what people miss, because you could do all this planning, you could do all these things which are just like, okay, it's all figured out because based on history, this is what you'll get. But today it's especially important to avoid being blindsided by potential obstacles or risks that could derail or even destroy your planning. This was basically talking about what weather are you investing in. We're going into a maybe a stagflation period here where we have inflation and a stagnant economy. But those things matter. The question a lot of people are asking is we're going to have a big downfall, a debacle, a disastrous thing. So you could plan all day long on the history of what's supposed to occur, but you throw a disaster in there and all bets are off. So you need to be thinking about what environment will this all be taking place in. So you identify specific risks. Now, in this presentation, I pulled some of the major risks out that I've published about in the past. And the global economic environment we currently see in the 2010s, which is when I did this, will certainly continue to be challenging to those approaching retirement. These planning challenges of the baby boom Gen X generations and its fringes, roughly people born from 1940 1973, will be uniquely different than those of their parents' generation. Different environmental, global economic challenges. And man, that just seems to be happening even more in the 2020s. What is the same? So this was sort of like what's different today. What's different today in planning is the global economic environment. I will stick with that in the 2020s, 30s, and 40s. It's not going to be like it was in the 50s and 60s and 70s when the Bob Hope generation retired. What is the same as it was? Well, today, in any efficient plan to provide for all adequate income needs in the 2010s to 30s, again, I did this for baby boomers, there's basically 12 essential risks that have been isolated. Do you know what they are? I'm going to go over a few of them in this presentation. All right. So when we get back to identifying specific risks, this is a report I wrote some time ago. It's not super available right now. I do have copies of it. It's just a little outdated in some of the current events we discussed, but it was called Inflation or Deflation: America's Monetary System in Crisis and How to Plan for It. It was an educational report from Straight Talk Wealth Radio. I wrote this, I compiled it. I'm very proud of how it looked. It was done so a high school sophomore could understand it. And in that report, it says you could buy all the stocks and mutual funds you want in the 2010s. You could buy all of the best foreclosure real estate. You could stock up with piles and piles of gold and silver, all that you want. But I'm telling you, if you call this shot wrong, inflation or deflation, your plans could all be for naught. And that was stated by Bruce Whitey of Straight Talk Wealth Radio. That was the author of that statement. All right. Again, I'm really trying to flip through this very quickly, but in that report, I did identify the 5 greatest risks, and this is a little section that we had in that report. And I'm not going to go over all of them right now, but I'm going to go over some more important ones. And the one I want to talk about first is market risk. Market risk that the American, if not the global economy, could be frail, and the stock market will be extremely volatile. As I recite this right now in 2011, we've just had a week where I believe the market has lost 4%. Some years, all year long, it only makes 4%. So we will also discuss a little bit longer here tax risk, historical increases in tax rates on businesses, working people, retirees, with both state and federal government getting ever more ingenious about inventing new ways to collect tax revenue. Boy, that is only going to get more intense in the future generations. And monetary risk, I'm going to talk about that one too. These are the 3 I'm going to cover. I don't know if this slide has more on it. It might. I'm going to skip through those. But monetary risk, serious possibility of hyperinflation or deflation, but which one? Call it wrong, and you could lose everything you've built. There's some other things, longevity risk. What do we got? Health event risks. I'm making this slideshow for a younger person right now. I'm not worried about those risks currently. Let's go to risk number 1, market risk. The American, if not the global economy, will be frail, and the stock market will be extremely volatile. All right. This is a chart. Again, I'll put a lot of these from old reports, but this does tell a story. It tells a period here of 1997 to 2009 or so of the S&P 500. Okay, And it climbed. Oh man, 1997 to 2000, we had the tech bubble in it, which is going awesome till it fell apart. Plus, we had 9/11 on it. And then until the middle of 2002, it was a wreck. And I remember those days, and it was people who had not been through the Great Depression couldn't believe that the stock market could take a tumble like that. But the Fed lowered interest rates. This was the beginning of the Federal Reserve really starting to intervene, starting to really impose its will upon markets and dropped interest rates, and the market came back up. But because of the dropped interest rates, we had a real estate bubble going into 2008 where they were artificially low. When I say artificially low, that means that the Federal Reserve is making moves that overpower the basic risk that a bank might be taking in its loans. A bank's going to look at what's the risk of making a loan to people, and it's going to determine an interest rate based on how much risk. But the Federal Reserve can interfere with that and drive interest rates down. And what happens then is that it's easier to get a loan, but it's riskier for the banks. And sure enough, by 2008, the banks realized they had loaned money on a lot of real estate that was overpriced, and then we had the crash going to 2008. Now, the reason I'm bringing this up is we're talking about market risk. We actually have a period here across the graph from 1997 to 2009, 11 years, 10 years, 11 years, there's no growth. You didn't make any money for 10 years. Think about it. If you're a younger person listening to this in 2021, you probably can't conceive that you would make no money for 10 years. That just doesn't happen. Well, when times are good, everybody forgets about the bad ones. But the fact is, during that time, you had a 66% increase over 3.2 years, but you just lost them. That's all. And then you came up from the bottom in the middle of 2002, and you had a 70% increase in the market over 4.8 years. So the market was growing. It just gave back what it grew at. I mean, if you took those two, 66% followed by 70%, you could have had 136% growth over 10 years. That's 13.6 a year. If you had just maybe locked out the losses, no, I don't know how you do that. I do know actually how you do that. But most people are going to, yeah, it's a really nice fantasy. It's a nice way of looking at it, Bruce. But if you take those losses, I mean, then you didn't really do that. Most people made zero over that period. Our people did approach some of these other loftier numbers simply by locking out the downside. So we'll talk about that in a minute. That is, here's another way of looking at it. In series number one, you got the total stock market return. These are totally hypothetical, but I'm doing it to demonstrate a methodology that we prefer to use for our clients than to put them at the risk of a crashing market. And that is, we'll take the one on the left and we'll say, okay, we don't want that because it's great. You get all the upside, but if there's a down, I don't want to wake up in the middle of the night and be up for a week calling clients and going through that anxiety with them. What we prefer to do is we take the one on the right. On the one on the right, what we do is we're going to make a little less than the market. We're going to take only a share of the market. So on the left, where this market hypothetically climbed to 250,000 from 100,000, we probably would have only taken the ride up to 200,000. But when the market collapses, as it does here in the middle of the first graph on the left, we either fall back on a minimum guarantee or we just go flat. But we never take a down of the market. We lock out the downside. So now the market is coming back on the red line from the bottom, and it finally moves back up to get even. Well, we're not taking that full gain, but the fact is, if we don't have to take the loss, we're now moving up again, maybe at a slightly reduced rate to the market, but we're moving up from where we left off, not from a dip. Now, this is called a fixed indexed strategy, and that is pretty much what we operate on. In this, let's see, we have some numbers that go into this graph, and they're all hypothetical, but again, it shows that you would have fallen to 152, but in our model here, you would have maybe just been stuck in first year at 189. 189 versus the 250 on the left wasn't as good in the good years. But when you have a disaster, now you're going up from 189 to 269 as opposed to just climbing back up to 238. It's during those down years our people celebrate because they know they didn't take the loss. And when it does come back, and they don't have to predict when it will come back because they're automated on all of this, they will come up not from the bottom, but from where they left off. And they have usually three words when they see a market crash, our clients, which is burn, baby, burn. Okay, let's see. This is another look, again, hypothetical, but it shows that if you took the S&P 500 from 2000 to 2008, this is where you would have been because you came in at the top of 2000, you took a hit in the tech bubble, you finally built back up by 2007 to where you left off in 2000, and then you took another hit. Our clients would have kind of held maybe a 1% minimum deposit over those first few years, would have taken reduced gains over the good years, and then wouldn't have had that loss in 2008. Again, this is a fixed indexed approach, and almost everything we're doing is going to have this as an underlying engine to get the growth. This is another chart. I'm going to skip it. It's just in detail goes back into it's a look at tables on how something like this would have worked. All right. Let's talk about monetary risk, inflation or deflation. And this is the time I did it. Ben Bernanke was actually the Fed chief. So I've been talking about these ideas for a lot. Inflation means that there's too much money out there. There's just a ton of money. It's floating all over. And so you got more money chasing goods. And so that excess money is going to be soaked up by the market. So in other words, I'm trying to think of a colloquial way to do this, but if we had 10 heads of cabbage in a room that we were going to sell, and people only walked in with $1 each in their pocket to buy cabbage that day, those 10 heads, and you had 10 people in the room, it's probably going to be $1 a head. But if everybody walked in with $100 in their pocket because they had a lot of dough and they were buying cabbage, the market for cabbage might go up to $10 a head because there's a lot more money floating around to buy it. That's inflation. What is deflation? Deflation is when all the assets, everything you thought you held, all your great houses that were propped up on bad loans, whatever it might be, that's where assets, it's realized that the assets that you own aren't worth the price that they previously fetched, and all prices come crashing down, and that is deflation. That's the difference between those two. They're important concepts to understand. There are very different winners and losers in each of them. I want to talk about deflation. Sorry that the slide got cut off there, because I think this is the one that's least known. And we've had 2008 was deflation. The Great Depression was deflation. So during deflation, you have false asset values. In the Great Depression, it was the stock market. Everybody was investing in the stock market, and so prices were just way too high. And then the source of funding those prices got cut off, and prices crashed, and people were running and the banks were even investing in stocks because everybody knows you made a ton of money in stocks. You just do. That's what it was like in the 1920s until people figured out that's overinflated, and then they literally didn't perform like they once did. So false asset values and exuberance are blown up by a confidence bubble with usual attendant banking risk that jumped in feet first into it. That sets the pattern for a deflationary crash. All right. So basically, again, during deflation, you basically have built a house of cards. Whether it's the real estate market, whether it's the stock market, it's some overvalued asset, and that comes the confidence in that price of those assets comes crashing down, and that brings everything else down with it. That's sort of what happens in deflation. I would be very alert to this. This is the big crash that people are talking about. When they think the whole system's going to go down, that's going to be a deflationary crash as opposed to inflationary. Inflation happens slowly or relatively rapidly, but it doesn't happen overnight. Deflation, overnight, it happens. You wake up in the morning and the stocks are crashing, real estate's crashing. Let's see, I forgot I had all these. The stock market is crashing. Deflation is a sudden occurrence, and you will not have time to pull out if you haven't been prepared. There was, I remember in 2008, the Federal Reserve, not the Federal Reserve, the Treasury of the Secretary went to Congress and asked at the time for $800 billion, almost $1 trillion, to bail out the economy. And his comment to them is the banking system is failing, it's caving in, and if we don't act tonight, we won't have an economy on Monday. That's how he responded. People say, well, what happened to the economy if we don't do this? He said, we won't have an economy on Monday. That was BS. But the fact of the matter is that's how paranoid it gets and how fast it happens and how you can extort $800 billion out of Congress by having things happen fast. Now, I just saw my people, not my people. I had people coming into the office for us to help them that were devastated. I mean, these people did exactly what they were told to do. They invested in the market. They thought they were investing for the long term, but as you get close to retirement, you're not long term anymore. If you're younger, you can absolutely take more ups and downs, but you still need to be cognizant of what your own tolerance is for those ups and downs and risk. Um, And oh, this is just another slide we put in. The risk was always there and lurking, but it was either ignored or what happens here? It was ignored or unseen. So the risk was always there. The risk in 2008 was there. The risk in the Great Depression. I mean, oh, there you go. Okay, fine. Thank you. So the point is that all of these things were